folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. We thought we'd come to you with a little bit of a market update after a wild ride yesterday in the markets. S&P 500 got down as low as minus about 4.5% before rebounding to close the day actually in the green. So we thought we'd just come to you with a little bit of thoughts on what's going on out there. Currently, as I record this, the S&P 500 is about 4330 in terms of an absolute level. That's down about 9.5% year to date, which is certainly a big number. But I would remind everybody that we're basically back to the levels that we were at back in October of last year. So a short 4 months ago, we were at this level. We had a strong rally to end the year. We've given a lot of that back, but we're still, sitting on sort of impressive gains since the beginning of 2021. So I would want that not to be lost on anybody. Volatility has been a little crazy. And what is happening is primarily U.S. focused. You can see that in a lot of different signs. You can certainly see it in the intraday volatility that we just talked about. S&P 500 is down another 2.5% today, but seems to be bouncing all over the place. You can also see that in asset classes that tend to get pummeled a little bit indiscriminately when this type of selling starts. So, for example, small caps are down about 11.5% year to date, which doesn't make a whole ton of sense because what's going on is really valuation driven. When small caps have had a much more reasonable valuation multiple than large caps for quite some time now. But when we start to get a little bit of indiscriminate selling, you see that sector sell off a little bit more aggressively. You see it in closed-end funds. Those are vehicles that through their dynamics, the share price is actually not determined by the underlying securities of the fund. It's more of a supply-demand dynamic. We've seen those start to trade at a discount of a couple, 3, 4, 5% to their NAVs. We've seen other signs of stress in the market, such as the fact that the U.S. market is down about 9.5% year to date, whereas the rest of the international world is only down about 4.5%, which is kind of crazy if you think about how much of that is accounted for by Europe, where they are literally amassing troops along borders to try and prevent an invasion of the Ukraine. It's very clear that this is a U.S. focused interest rate valuation conversation, not a global economic conversation. And the indicators would give you that there's a little bit of indiscriminate selling out there. It brings up this notion of, which we've talked about before, that the market in the short term is a voting machine and in the long term is a weighing machine. We're big subscribers to that theory that over the long run, the market kind of gets the valuation pretty correct. But in the short term, it's a voting machine. And if more people are pushing the sell lever than are pushing the buy lever, if fear kind of overtakes the market, then you get to kind of get these sort of indiscriminate sell-offs, which is kind of what we've been seeing. It's a little silly to think to yourself that at the beginning of Monday, the United States was at one value. Midday, it was 4.5% less valuable over the span of 3 or 4 hours. And then by the end of the day, it was actually back to its old value plus 0.5%. It's difficult to argue that that's a real rational judgment of what the value of the U.S. equity market is. It's a little bit more of a knee-jerk reaction in one man's opinion. It also brings up the difficulty of trying to time any of this, right? So even if you called that yesterday was the right day to sell or move your portfolio around, depending on which hour of the day that you tried to do it, you may have gotten an execution price that was 3, 4, 5% difference, middle of the day versus closing, whatever that might be. And I know that sounds 3, 4% sounds small in the context of like a 10% decline since the beginning of the year or, a 30% return last year in equity markets. But keep in mind, we generally expect equities to return right around, 9 to 11% in any given year. Being wrong by 3 or 4% on a trade is 30 to 40% of your annual return. So it brings up the phrase, which is one that we used to use on the desk all the time, that, trying to time entry rebalancing on any of this stuff is a little bit like trying to catch a falling knife. It looks really cool if you can do it, and it hurts really badly if you get it wrong. So we continue to just exercise caution around, rebalancing over time and making sure that everybody's in the right place. But we wouldn't encourage clients to be making drastic moves with their portfolio at this point. Now it's just not really the time for it. Last but not least, I would just point out that my sister made the comment to me that I've said on numerous occasions that I do not have a crystal ball. And so she mailed me one. Which will become a permanent feature of the podcast studio. Thank you for that, Kelly. I really appreciate it. And I still don't have a crystal ball in the way that would let me predict the future in terms of where we're going in the next week or two. But at least I won't be able to say that on a go-forward basis on these podcasts. So I appreciate that. Thanks for the humor. As always, if you guys have any questions, please feel free to reach out to me or to your advisor. And I hope you're having a great day, and I look forward to talking to you again soon.
Thank you for tuning in. And if you're enjoying this content, please subscribe to our YouTube channel and click the bell to be notified when we post more.